Good afternoon to all of you. My name is Daniel Beunza. I am Associate Professor of Management at the Business School, formerly CAS, and I am also a member of the Center for Charity Effectiveness. I would like to welcome you all to today's Food for Thought webinar. This is the first of the autumn series. We started this series this past summer, and it's been such a success that we decided to continue with it. The title for today's webinar is "Do we still to worry about bank misconduct?" And we are going to be hosting Professor Barbara Casu. But before I introduce Barbara, just a few items of housekeeping. The way in which we're going to proceed is that I will be interviewing Barbara, asking her questions between now and 1:30. And then after a few questions from me, there will be time for you in the audience to ask questions. To do so, please use the Q&A box that you have, and then I will be reading from there. Okay, so I'm incredibly pleased to welcome Professor Barbara Casu. Barbara is the director of the Center for Banking Research at the Business School and also the course director for the executive PhD program. Her main interests are in empirical banking, financial regulation, structured finance, and corporate governance. She has published widely with over 40 publications in peer-reviewed journals, and she has also written a very popular textbook titled Introduction to Banking, which has then been widely adopted for banking courses across the world. I could go on and talk about her recently co-edited book and her consulting and visiting researcher positions in places such as the IMF, the European Commission, the Center for European Policy Studies, or the Building Societies Association, as well as the SWIFT Institute. But let me now turn over to Barbara. And I'd like to start by going directly to the topic of today's webinar and asking her, Barbara, bank misconduct has been at the center of the global financial crisis of 2008. But it is now more than a decade after the financial crisis. So let me ask you, do we need to still worry about bank misconduct today?
Thank you, Daniel. That was a good introduction in the sense that you make me sound more important and professional than I actually feel myself. But I am honored to be here today, and I want to thank you for hosting this conversation, and also thank you to Caroline, Andre, and Anish for putting together this great series, and for asking me to open the autumn series with this very important question: is bank misconduct still a worry? When we started discussing this in the summer, one of the issues that appeared was, is really something we should still be concerned about, or all the issues that we are dealing with are still legacy issues that banks are trying to resolve since the financial crisis? But today, I can give you a very definite answer. Yes, we still need to worry about bank misconduct. So the latest bank scandal has made the headlines at the weekend, the FinCEN files, which uncovers years of money laundering by the world's largest banks, including HSBC, Standard Chartered, Bank of America, Citibank, JP Morgan Chase, and American Express, has been hitting the headline after the investigative journalist discovery that banks were filling in what are known as suspicious activity reports And these suspicious activity reports were drawn up by financial watchdogs inside the banks. So people in charge with the compliance function, they were writing reports of suspicious activities, but these were not followed up. So this is the latest scandals. These were not followed up either by the banks themselves or by policymakers and regulators. So this leaves a lot of unanswered questions about the way banks are still behaving and the regulatory structure that has been put in place since the 2007-2009 financial crisis. And these questions are really, what is the culture of banks? And have we developed a culture of compliance where banks are following the rules, filling in these suspicious activity reports, but then they stop there and illegal activities are still continuing?
Right, and it is absolutely the case that this week is a particularly key week that illustrates all this incredibly large amount of work that needs to be done to fully accomplish the goals of financial reform that we started to see as a huge necessity all the way back in 2008. But this takes me to the question of what is it that academic institutions and specialists in finance like yourself ought to be doing. Now, I know that the Center for Banking Research has decided to host the so-called Conduct Cost Project, which is a project that was, if I understand correctly, initiated outside the business school, but that now it is going to be hosted, it has been hosted at the business school and at the Center for Banking Research. Barbara, please tell us more about that project and more generally perhaps about the Center for Banking Research.
Okay, so let me just say a couple of words about the Conduct Costs project. The Conduct Cost project started, as you say, in 2012 at the London School of Economics, but some colleagues and researchers that are still involved with the project today. So there is a continuity in the project, but the project transferred first to the CCP Research Foundation in 2014, continued the work that they started and moved to the Center of Banking Research here at the Business School in 2019. What we have been doing since May 2019 is to take a closer look at the data that the report, that the project puts together on bank conduct. And I'm going to tell you a little bit more about that. We have updated the data to 2019. And we are really aiming to increase the transparency of the information that is available to the public, to investors, to shareholders, to consumers about the way banks are behaving, which is not only fines, as we have seen, but is also all this regulatory redress, these notices from regulators, these provisions for compliance costs. A lot of it goes on that is really difficult to piece together and is really difficult to understand what the cost of this conduct, or if you want, misconduct, is for financial institutions. So this was launched last week. We launched the next phase of the Conduct Cost Project last Tuesday on the 15th of September. The project was launched with the key results, and we also had the support of the European Banking Authority. The chairperson of the European Banking Authority gave us the keynote speech, and they are very supportive of this idea of increasing transparency in the financial and conduct conditions of banks. And this is true particularly for European banks, where the plethora of regulatory authorities and national authorities and various other bodies that are in charge of supervising the conduct of banks sometimes do not talk to each other.
That is so interesting. So if I understand correctly, the message that the center is sending is that there's a very clear cost for banks that engage in misconduct. And to drive that message home, the center has been adding up all the plethora of possible costs, such as fines, but other costs that the banks have been incurring in. So, can I ask you more about the findings of this report? What is it that is coming through from this very thorough adding up exercise and analytical exercise that the center has been doing?
Okay, let me start with your first question about the costs of bank misconducts. And the cost of bank misconducts go beyond the cost to banks. There are costs to consumers who suffer the consequences of bank misconduct. For example, the cost of PPE. A lot of retail consumers and households have been paying for years on this payment protection insurance that shouldn't have been added onto the cost of their mortgages. So it's not just the bank that pay the cost, but it's consumers, it's clients. Let's go back to the big scandals of the financial crisis and the mis-selling of mortgage products and residential mortgage asset-backed securities. So there are costs to society, there are costs to clients, there are costs to the system itself because it breaches the trust between the financial sector, the banks, and the rest of society, and can therefore have implications even for financial stability and bring about another banking crisis if the trust in financial institutions is lost. So when we talk about the cost of bank misconduct, we don't have to focus only on the fines that banks are paying, but really that's the adding up that we are doing to the bigger picture and the bigger costs, as it has become really clear by the money laundering scandals that we are reading upon these days. So with the cost conduct project, what we are trying to do at the center and with all the researchers involved in it is to foster transparency in financial activities. We want to deliver an analytical tool for banks and shareholders and investors to benchmark conduct risk and the overall level of conduct costs. We want to provide clear and publicly available metrics for banks' conduct cost. And, ideally, we would like this to help promote a more ethical culture in financial firms. So one of the things we want to do, for example, is to produce a conduct cost index, which is, similar in spirit to the ESG index that various providers such as Bloomberg are now providing. And banks and institutions are ranked in terms of their ESG credential. Of course, is not perfect, but the more information the public has to and investors have to make decisions, the more transparent this information is, the better decision can be made, and the more pressure can be put on banks and bank management to actually behave better.
So if I understand correctly, then it's really this essential idea that markets need information, and that information needs to be provided in a transparent fashion. And so by providing more information and creating transparency, it will hopefully create an incentive for all economic actors, including, of course, the banks, and to avoid these various costs of misconduct, which not only are the fines, but also, as you rightly pointed out, all the various costs to society and the various stakeholders. Now, perhaps one question that then I should ask is, okay, so I understand all these. Suppose then that I am a bank, decision maker in a bank. What is it that banks ought to be doing with this information? How can banks act upon the information released by the Conduct Cost Project in order to, in a way, be behave better?
That's a very interesting question. So let me take a step back and discuss the lack of transparency that these kind of issues are faced with. So from the regulatory point of view, there is a little bit of reluctance to disclose a lot of the interactions that are going on between the regulators and banks. And this is often done in the name of financial stability. So if, let's say, the public was to know that a bank is in trouble with regulators, that could cause a run on the bank, meaning depositors and investors taking their money off the bank, and that could cause even bigger problem for the system than the problem the bank has with regulators. There are a lot of instances where banks and regulators enter in some kind of negotiation. We have a few examples in Europe where banks have been paying fines on the assumption that the regulator was not to reveal that they have paid fines and the reasons for the fines. So the fact that sometimes all these issues can be hidden from the public view means that banks don't have to worry too much about it. So if shareholders, stakeholders, investors, and the public don't know how much Bank X has paid to regulators in the last few years, is really not the right incentive for them to stop doing what they are doing wrong. So what we are advocating is that if this information was out in the public domain, then investors, shareholders, customers could actually make a better decision and exert pressure on banks that are notoriously misbehaving to stop doing what they're doing. It is a double-edged sword. Of course, we do not want more banks failing. We do not want more banks bailout. No one is advocating a return of the turbulence of 2007, 2009. But at the same time, banks can really hide behind the secrecy.
Very interesting. So the overall spirit, I would say, of the Misconduct project really speaks to the idea that sunlight is the best disinfectant, and yes, that sometimes in the name of stability, banks can end up, so to speak, hiding behind the regulators. But I wonder, Barbara, if are we not unfairly focusing too much on banks? After all, now if one looks at the financial sector, it has gone through a tremendous evolution since 2008. And now I would say that the financial sector is not only made up of banks. What are your thoughts in this regard?
There are several important developments in this area. The first one is, as you say, the growth of other players, being it new banks, digital banks, fintech players, but also a lot of non-financial players and the growth of market-based finance. So we have seen issues and scandals in these markets. You know, one of the most recent is the failure of Wirecard last month. So fintech will fail, but the impact is not as big as bank failing. Having said that, regulators are aware of it. From our research, it comes up. The next scandal might not come from the banks. The banks have been heavily regulated. There have been really a lot of regulatory pressure on them since the financial crisis. And hopefully some of the legacy problems have been resolved. But to give you an example, one of the things that is worrying regulators at the moment is that the next PPI scandal might not arise with banks, but with insurance companies and with pension funds. So as the rules change and people can transfer their pension to private providers, again, the incentives there are wrong. So the next scandal might not arise in the banking sector. So regulators are aware of this.
That's very interesting. It suggests that there's going to be no shortage of work to be done by the Conduct Cost project over the coming years. By the way, a reminder to those of you in the audience to feel free to send questions. Please use the Q&A box, and I will then read out those questions to Barbara. We still have a few minutes left, but there is a question that has been on my mind, and I think that this might be appropriate for the topic of today's conversation, which is we are, of course, now living through very unusual circumstances in the midst of the COVID pandemic. Barbara, could you please share your thoughts about the implications of the COVID pandemic for the potential for bank misconduct? What, in your view, are the potential concerns out there that we ought to be looking at?
There are a lot of concerns at the moment. At the height of the coronavirus crisis, banks were seen more as a part of the solution in many countries, as they have been helping, passing through to the real economy a lot of these government subsidies and emergency loan to companies. But even there, we are starting to see some issues crop up, with banks attaching conditions to these loans. So there are investigations going on, attaching conditions that shouldn't have been there, and maybe disbursing the funds to companies that shouldn't have been receiving the funds, so that there is this whole issue there. Another important issue is what will happen, particularly in terms of non-performing loans once the government subsidies and guarantees expire and the loan moratorium expire. But another interesting aspect is the fact that a lot of us have found themselves moving on to digital banking, being it using your smartphone a lot more or using your online banking a lot more, with the fact that you couldn't go into branches. Even services and people that wouldn't have before used these digital services are now using them a lot more. And they have been victim of frauds. So there is a lot going on. Maybe it's not huge amount of money, but there are a lot of issues that regulators are aware with digital payments, particularly small payments where people are requested to send money, the payments that appear online, and various type of frauds in this transition to a quick digitalization of the payment services.
It's fascinating how suddenly the entire COVID context is really creating a new scenario with all these complexities. And of course, we know that banks have been instrumental in the efforts that the government in the UK has put in place to keep the economy going. But of course, there are going to be some complexities associated with that. Now, we have a question from the audience, actually 3 questions from the audience. As we are doing fairly well on time, I'm going to quickly read the questions and then let you perhaps choose how to address them. We have a question from Anna, and she's interested in Barbara's thoughts about the following. Why is there still confusion about what conduct risk is and how to manage it? We have a question from Wendy. After 2008, there was some talk about the systemically important designation being a badge of honor. Does Barbara think there is any likelihood of financial firms reframing a close relationship with the regulator as a positive thing? And finally, a question from John from St. Andrews University. John writes, can I ask you to reflect on your knowledge of academic research in banking and speculate as to whether bank stakeholders, such as depositors, equity holders, bondholders, punish banks for bad behavior? So 3 questions right there on conduct risk, on systemically important banks, and on the punishment for bad behavior. Please.
Well, thank you. They are all very interesting questions. So the question of conduct risk is very important and is one that we are grappling with in our research. The key issue is that there isn't a clear definition of what conduct risk is. So misconduct is very broad. It can come from individuals, it can come from the organization, it can also come from the whole sector. If you think about the LIBOR scandal, it was not a particular individual or a particular bank. It was widespread manipulation of benchmarks at the sector level. So that's why it is really difficult to define what bank misconduct, what conduct risk is. Having said that, it's becoming more and more important, and this is one of the things we're working on, to give clear definition of what conduct risk is. The idea of conduct risk was introduced a few years ago by the UK Financial Conduct Authority and is used to indicate any action by either a financial institution or an individual working for a financial institution that leads to a negative outcome either for a customer, for competition, or for financial stability. So it refers to the way that bank employees conduct themselves in the treatment of customers and whether they can maintain integrity and behavior that supports the reputation of the institution.
Barbara, forgive me for interrupting. We should be finishing, I know, at past. Yes. So if I could ask you to perhaps very briefly what are the 2 remaining questions?
Yes, so conduct risk we need to define. Systemically important institutions, it is really not a badge of honor at the moment because it is the largest and the most cross-country institutions that seem to be at the center of scandal after scandal. So probably a different relationship between systemically important financial institutions and regulators is important. And to address the final question, yes, they should. Depositors in particularly, they should punish misbehaving banks. However, a lot of depositors, A, are not aware of what is going on, and B, the cost of switching bank accounts, both for households and for firms, are still very high. And it's really difficult to expect the pressure to come from small depositors.
Thank you so much, Barbara, for this important work at the Center for Banking Research.
Thank you, and thank you all for listening.